risks out there, as they say, that we just have no idea about.
I mean, we have, ask anyone, I mean, we've talked about it so much that you ask anyone on the street, interest rates are going up. What does that mean? It's, well, it's bad for the NASDAQ, bad for tech. Everybody knew that interest rates going up can have a deleterious effect on things. Why did we miss the ball on duration risk? And knowing that we were at zero for so long,
right? Shouldn't
we have known that there's a lot of paper out there that isn't marked to market? I mean, and we're hearing more and more about loans, insurance companies, commercial loans, mortgage backs, real estate. Everything's marked at par, and it's not at par.
I think the one piece of good news in that is that the nature of the securities are, if you look at Silicon Valley Bank, it was treasuries. So enormous exposure, enormous mismatch in terms of the assets and the liabilities.
But money good eventually.
But eventually money good.
What about the $90 billion in loans that the FDIC is still setting on it?
And that's where we don't know. And that's one of the issues that we'll see flow through the entirety of the economy. I would say that the probability that earnings are going to meet expectations in the next couple of quarters is not high. I think that's going to be something else the market's going to try to absorb. I think we've migrated the economy to business models that are better business models and that represent a higher percentage of the public equity markets than we had a decade ago. I was saying to somebody today that in the 4 decades I've been doing this, there have been numerous times where we've said, gee, that next generation is going to have it much worse than we had it. There's not going to be any growth. And yet ingenuity, technology, often deregulation leads to these spurts of significant growth that's been very helpful to the U.S. economy. And obviously, we're a major player in the entire global economy.
Is it going to happen again?
Helpful.
Is it going to happen again, or have we run our playbook on that?
Yeah, I think if you look at what's going on in life science, the technology's driving significant improvements in life science. If you look at the things that have come out about generative AI and the possibilities that has to improve productivity, we're not going to get there, I don't think, by bringing wage rates back down to under 2%. I don't believe that's
interesting. Yeah,
probably what's going to happen.
So the Fed might be looking at the wrong thing.
Well, no, I think what they're saying is let's get it down to 4 to 5%, and let's hope productivity brings that down to a 2% target. And so automation, productivity, in lots of different ways are going to be really critical to making that work. And hopefully that will happen. But in the near term, midterm, I think we're in for more pain before we get to that place.
Was your base case before Silicon Valley Bank a recession in 2023? Does it make it more likely, or the Fed, it might cause the Fed to take its foot off or at least to tap the brake on the rate hikes?
I think the Fed did the right thing by raising 25 bips.
Really? Not everyone does.
I think the messaging of not doing that would be very difficult. I think you all have pointed out the Fed has a credibility issue because they missed early on. I don't think the members of the Fed are ignorant to the fact that inflation is the most insidious, most difficult to control of the financial ills that we deal with, and trying to bring it under control is important.
What caused it?
Obviously, we had
pandemic spending.
Well, not just pandemic spending, but if over
spending in general,
over a decade, we've seen the Fed balance sheet inflate significantly, and then it had a massive inflation. But it's also been the fiscal policies that have led to a hyperinflationary.
But it was staying at zero causes bad investments, and staying at zero expands the balance sheet. Quadruples it or quintuples.
Yeah, and there is, again, if we end up at a 4% rate, 5% rate on a sustainable basis, historically, that's not that high. That's not that high.
No.
We had just gotten used to free money.
And
free money creates these kinds of
the only solution
problems.
seems to be to go back to the free money, because in the last 2 weeks, I think the Fed has unwound about 80% of the balance sheet tightening that it's done.
They have, and if you look at what this most recent deal, they're basically saying, bring all of that paper that's currently should be marked at 70 to 80 cents. We'll give you 100 cents for it. I'm not sure longer term that's great policy, but again, the nature of the choices they have are not attractive. So you can look and say, we should have let Silicon Valley Bank do whatever it was going to do, and all of the uninsured depositors, which were an extraordinary percentage of their deposits, tough luck. But the flow through of that was not worth it. I think they made a better decision, even though it's not one that theoretically I like.
Given the 10 years at zero, is just Silicon Valley Bank, that's it? Is that as bad as it's going to get? Did you expect more?
I think the issue that Silicon Valley Bank confronted was more extreme because of the nature of their profile. I don't think it's unique. And I think we know that there are lots of issues out there. There are issues, people are have been investing in a number of things that I think were the product of a bubble market, whether it's related to anything cyber, anything, or it's related to the value they put on a certain set of cash flows. And again, the uncertainty about what those cash flows are going to be, at least over the next 2 to 3 years, I think is higher than we thought it would be. And the discount rate is obviously higher.
So are you excited about opportunities for
I think so.
right now? You are?
Yeah.
Where?
Over the last 5 or 6 years, we've been more net sellers than buyers. Not because we weren't trying, we just lost.
Yeah.
Now, thankfully, but